Fiscal stimulus has been a major contributing factor to the resiliency of household income. This dynamic is dissipating at the margins, but is unlikely to fall off a cliff. So this is our fiscal policy monitor. We're showing the nominal year-to-date sum of the very fiscal dynamics across revenue, expenditures, and the budget balance. We're showing the share of total by category, year-over-year rate of change, and the trailing 10-year Z-score with that year-over-year rate of change. And so, as we said, the fiscal stimulus has been a major contributing factor to the resiliency of household income, and it's actually moving in the wrong direction now, but it's unlikely to fall off a cliff. And so if you look at the year-over-year nominal delta in the federal budget deficit, on a year-to-date, year-over-year basis, we were up $834 billion in June year-over-year in terms of the budget deficit. The budget deficit is now only $320 billion in the month of November. But that's actually higher than what it was in September and October. And what's important about that is because we are now in fiscal 2024. Q4 starts Q1 of fiscal 2024. And so the fact that we didn't have a level reset lower in terms of that year-over-year delta is actually quite positive. And it tells me that fiscal policy is unlikely to fall off a cliff when you look at the, especially heading into an election year. A couple of other dynamics I'd highlight really quickly. We are seeing a COLA increase of 3.2% in 2024. That's much lower than what we saw in 2023. So some of the things that were quite positive on the COLA front that were supportive of fiscal stimulus here are going to be you're going to have less of it in 2024. Medicare, for example, 14% of federal budget deficit, or federal budget expenditures, growing 19% year over year. That number is going to slow. If you look at Social Security, 22% of the budget, federal expenditures, that number is growing 12% year over year. That number is going to slow. And then if you one thing that's going to slow as well is the year-over-year rate of change of net interest that's being paid out to the private sector, people who own treasury bills, treasury bonds. That number is up 43% year over year. That number is going to slow as well, in our opinion, just given, as long as we keep rates where they are, the year-over-year change is going to slow. And obviously rates are likely to come down given what's priced into the markets, which we don't agree with in terms of the absolute level of what's being priced in the markets. But we certainly believe in, the policy rate cutting, the technical rate cuts that the Fed has outlined in the December FOMC.